Welcome everyone to our Socialsuite webinar on why does ESG matter to investors. Today we're going to look at how your sustainability and ESG data is used by investors and what you can do to really position your company well to make sure that investors see what you're doing around ESG and sustainability reporting. Socialsuite is a ESG and sustainability reporting platform. We work with companies across global exchanges, and we've helped so far over 100 companies get started on the ESG journey to demonstrate the impact they're having in the world and really ensure that their ESG and sustainability reporting is available and visible to investors. I'm really happy today to have two guests here. Already have Andrew Rodriguez here with me, and Sandeep Gupta is logging in at the moment, so he'll join us in just a minute. What I'd like to do is, rather than just read someone's biography, is just really ask Andrew if he can introduce himself in a brief introduction, and maybe in that flag a little bit what it means to you to be a so-called impact investor, and we'll unpack that concept a little bit later. Andrew, welcome to the webinar. Thanks for joining us. Can you give us a brief overview of what your background is as an investor at Change Finance and what you focus on?
Sure. So I run a firm called Change Finance, one of the founders, and I designed the strategy we use that's publicly available on the New York Stock Exchange for people to purchase. It's 100 of the S&P 500 companies, focused most on how they perform in terms of sustainability, what they report to us, and where they're headed. Looking into the future, because we see the investing we do in public markets as a long-term investment model for companies that are going to both outperform because they increase their revenues through smart management of their organizations, lower their costs over time, because many of these things go hand in hand, and also avoid a lot of the costs that are associated with transitioning to being a part of this ESG sustainability impact regimes that are out there in the world, because they directly correlate with where global policy is shifting. And as investors, when global policy shifts, policy of any sort shifts, there's this real strong opportunity for alpha generation, outperformance. And so we see the type of investing we do and the pieces we pay attention to as key to outperforming in the long run in public markets.
Excellent. So you're really kind of linked sustainability and ESG, for that matter, to return on investment, really making sure that companies are not just doing the right things, but are also a strong business proposition that supports the company in the long run effectively.
Mm-hmm. Exactly.
We'll get back to Sandeep when he's able to join us in a minute. For now, what we want to run through today is a few key topics there. And we'll start off with a little bit of the difference between ESG, sustainability, and impact, and really does it matter? From there on, what we'll do is we'll look at a different type of investors and also see it, do they equally care about ESG? What pieces of ESG information and data are really most valuable to investors? So if you're on that ESG journey or considering to start there, what are the key things that you should focus on? And then how do you get that information? How do you highlight that in a easy way so investors can actually find it? And finally, we'll end with 5 key, what we call ESG moves, or things that you can do on your ESG journey to make sure that you actually maximize that value to investors. We generally look at our webinars for small and mid-cap companies to make sure that they, with the limited resources and ESG team they may have, still can really kind of ensure that they get the maximum value from sustainability reporting. So that said, the first things that we always want to get out of the way is the ES elephant in the room. The ESG elephant is really like, what are we talking about here? And a lot of people might have heard that ESG is a bit of a poisoned or spoiled concept these days. Some people don't even want to talk about it anymore. We've seen that BlackRock has always been one of the key investor proponents of ESG, and they've been quite silent on the terminology ESG lately. It's not that they don't support it anymore, but they phrase it in different ways. So I think there is a difference between the concept of environmental, social, and governance versus the potential political designation it has gotten over the last year and a half, 2 years. So with that in mind, Andrew, that ESG controversy, or that the terminology itself, what does that really mean? Does it change anything for your work? Is it something that you're really kind of aware of and have to be careful around, like how you look at things and how you label it? And is that really a US thing, or do you see that happening globally?
Yeah, great questions. So our fund that's publicly available certainly has the term ESG in it, and I think it's at the end of the day, I would say to you all that it's not really a controversy. It's not really something that is driven by more than politics. Oftentimes, what's held up is a bit of a straw man about what ESG is and what it's doing. That it's some sort of, they'll use this term woke investing, and I think what they mean by that is that we're all signaling just in some sort of virtuous way that we only want to support the companies that are that look good in terms of more progressive politics. And so I think this is something quite unique to the U.S. I think there might be a bit of this pushback in Canada, but really how it came to be was that the Republican Party in the United States is very much invested and invested in by fossil fuels. And more as we look at what the long-term trajectory is of something like the fossil fuel industry, we see decreasing demand. We see pushback in global policy. We see big changes coming. By 2030, many of the world's nations, including China, India, many parts of Europe, are going to ban the sale of fossil-fired cars and be entirely on electric vehicles. And so we see this dramatic decrease in demand coming. And so at the end of the day, all of the investing we do in the environmental, social, governance range as we look at these issues is related to good investing, is related to the idea that you need to spot what the trends are and really be paying attention to what's going to drive outperformance. So we use this framework. There's a simplified version of it, and we'll get into that in a number of next slides, where you can get an overall score from a company by ratings agencies that says, hey, this company qualifies as an ESG investment. Oftentimes at best, they're saying whether this company is good enough on some measures to be invested in. But for a company like ours, as we've always been, and as we invest in this manner, we're in fact looking really deeply under the hood at what are the environmental issues that a company is managing towards right now, and how are those materially linked to the top line revenues, the expenses of a company being decreased, how are they spotting future trends, and how are they prepared in advance for how policy is shifting. Same on the social side. This is usually a place where folks give pushback in the United States and say issues related to diversity, equity, and inclusion are somehow, again, just a kind of signaling of what's virtuous, where in fact, study after study after study points to things as simple as the makeup of the board and how diverse it is, and how by the time a company comes to have a board of 30% or more women in oversight and leadership, that those companies tend to outperform over time. And what we think about that is that at the end of the day, genius and smart thinking about where the world is headed is equally distributed. People who look just like me aren't the only ones who have good ideas, and in fact, we probably have our own blind spots. And so the same applies within the organization. If there is good diversity, not just at the floor of a company, but in management and in the C-suite, people are spotting more of what will drive revenues, drive new product development, spot the sentiment in terms of the public about what they want to see and what they don't want to see from companies, which often links directly back to how sustainable and sticky those revenues are for an organization. And then lastly, on governance, this is an area that's always been shown to have dramatic outperformance. So, companies that are ethically run, that are independently run, that pay attention to how they show up in the world and show up in all of the various legal frameworks, those companies also tend to outperform. So at the end of the day, I think it's been set up in a way to make it look like it's as little as a spin on progressive politics trying to drive a certain direction in terms of corporate outcomes that would link back to policy outcomes. And in fact, at every turn, these issues, especially that a company like Change Finance identifies and measures within a company, and we measure in our methodology over 100 different metrics on companies. This gives us a much better view into how that company will outperform, what risks they're managing towards, what opportunities they're managing towards. So I'm of the opinion that there's nothing wrong with the term ESG. I think there's something wrong with the conversation, and like so many conversations in the US, politically speaking, a lot of it has to do with a set of ideological values, moral values, and in a sense of what serves politics. And so, we can certainly talk about that if that's of interest to people to talk about. But I would say most of the companies in the U.S., whether they're calling it ESG or not, in terms of the sustainability work that they're managing towards, they're continuing to head this direction. The European economy is just as big, if not bigger, than the U.S. economy, and they don't want to find themselves behind and find themselves at risk of their business model in other parts of the world. So this isn't something that's slowing down. This isn't something that's changing because it's political in the U.S. If anything, I think it's laughable around the world what we're saying. But hell, if we want to call it sustainable investing going forward or something else, great. But I'm not at all surprised to see organizations like BlackRock and others pull back from the term, in that the majority of what BlackRock and others invest in is the entire market. And so the scale of investment that they have puts them in a boat where they're conflicted at almost every turn. And so pulling back from the term in many ways, for them is a move to save face, to not lose access to pension funds in the state of Florida and Texas, even though at the same time, much larger pension funds in New York and California are continuing to head down this direction and demand this types of reporting from companies and expect that to outperform in the long run. So at the end of the day, it's political. I don't even know if in the end of the day it'll be poisoned, but I do certainly think that it's a frustration to see us pull back from really good business and really good investing just for the sake of making an argument and making an opportunity to fight in our politics.
Thanks, Andrew. And so what I pick up out of that is that ESG is effectively just a tool to enable investors to really look at what is a good investment, to look at, looking first and foremost from a financial perspective, is this company doing something that, will outperform the market, doing well? And in that plays a subset of non-financial disclosures, which are those ESG or sustainability areas. And how's the company performing on that? And that will inform us, if they're set up to do well in the long run. So with that, if you think about investors at large, you sometimes hear about, you got your traditional investors who just have that financial lens on. From there on, we hear all kind of terminology from ESG investors, responsible investors, impact investors. They're all have potentially slightly different lens there. And I think you already flagged some of this. What is your view? Should companies really care about how an investor is labeled or labeling themselves? Or is it more about just doing the good work, and the right type of investors will link up with you from that perspective?
Right. So my view is that at the end of the day, traditional investment is going to come to look like many of these categories, if not all of them. Just going back to early economic theory, we often talk about in public markets that they're efficient, right? That at any given day, that price of that company is correct. And it's based on the idea that we would have access to a full set of information about companies to be able to determine if that company warrants being a good investment for the next week, the next month, the next 10 years. And so many of these issues that we pay attention to about corporate performance in these various areas is really driven by good and sound investment principles, and the idea that the more information that we have, the more we can both manage to risks, as you see down managing ESG risks, but also to the opportunity that those companies have to come to steal revenues from other companies that are laggards, that are already taking the steps necessary to be a part of where the world's headed. So they'll have less costs in the long run by more efficiently addressing them now, while those costs are low and they're already in the lead. So, for a firm like ours, we're not doing ESG integration. I'd say that is probably where a BlackRock might stand. They probably involve some exclusionary negative screening on certain portfolios. Even on some, they might do this norms-based screening, right, looking at some of the controversies that they're out there, whether they're environmental, they're looking at the supply chain, their labor force, their involvement in key areas, their revenues tied to anything from genetically modified corn to uranium mining, you name it. You have access to all of this sorts of information, and so that's probably where BlackRock taps out. But we find that in terms of a group like ours, we at least head into this next area of corporate engagement and shareholder action, really pointing out and engaging with corporations to say, all right, you're already here. You're already taking these 10, 17, 700 steps to measure how you are behaving in all of these ways and learning how to report them in these global reporting regimes that are growing. And here are the next set of issues that you're probably not considering and how they directly affect your bottom line. And so you can do them, certainly, if you want to do them for the right reasons, however you think of that politically, great. But at the end of the day, we tie them all back materially, either to the expense lines or the revenue lines, and where those trends are headed in the future. Ways that we would likely stand out is that we find that there's also opportunities to drive real change, right? There is somewhere between 7 and 8 teratons of carbon, so 7 or 8 trillion tons of carbon that's in the atmosphere, directly impacting all of us, everyone from Barcelona, Spain, to me here in California in the United States, that are seeing these dramatic changes in how the world works, the fragility of our infrastructure against the force of a changing climate. And so there's opportunities certainly that we've found to engage with that. So one way we're able to do that, in part because of the good reporting of, honestly, almost every company now, at least in the S&P 500, if not the Russell 3000, reporting on their carbon footprint. And so we can look at that. We can look at the trajectory of where their carbon footprint is going. But also we have taken the step of measuring the emissions, the scope 1, 2, and 3 emissions of these corporations, and then on our own, using land-based solutions and paying towards land-based solutions that actually sequester carbon back in the soil. If we want to return to the world we've known and felt stable, in fact, we're not looking for carbon neutrality as a planet. We're actually looking to go carbon negative because at this point we've destabilized things to a degree you're all experiencing. And so by putting back the carbon emissions that these companies, at least those associated with the scale of investment we're doing, by putting those back in the soil, we're able to actually drive some positive impacts along with our shareholder engagement that certainly our clients definitely fit with our beliefs about what's long-term good for these companies and their sustainable profits. If a corporation based in Houston is going to see increasing risks of flooding and the potential for hurricanes and the risk to their infrastructure, there's been some really interesting studies recently starting to map this out. What are the companies with the biggest infrastructure risk of how they built their business model if climate change comes to affect us, as it all seems to be happening? By putting the carbon back that's associated with doing business these days, while we're in the middle, if not the beginning middle of a transition to renewable energy sources, transition to an electrification of our grids globally. We can be a part of actually stemming the rise of climate change. And honestly, we think that more and more companies, Daniela from the Savory Institute, you certainly know Hunter Lovins, who we who's helped lead our impact methodology work. So we think that this is a way that we can contribute that actually is going to, in the long run, lead to more sustainable business models, not just create impact for impact's sake, or to make some sort of big pitch for democratic politics in the United States, something like that.
Thanks for sharing that. I think that's a good kind of overview of where investors sit, and especially where you would change finance come from. Mm-hmm. If we think about that, then I think you've already flagged some of these things, but it's really useful for people to start thinking about this. When we talk about ESG and the E and the S and the G, then all of that is important for various reasons there. But mm-hmm. we do see that investors sometimes particularly care about a certain subset of ESG metrics, or about one of the three key pillars there, and say, that's my focus area. That's really what I'm looking at first and foremost. Mm-hmm. So what I've done is some of the common topics here that we have around sustainability, around those three pillars: the environmental, social, governance. And then under that, we have the 5 sustainability dimensions that SASB often uses, with a number of topics. That's not a mm-hmm. finite list. There's a lot of people that might phrase it or group it in slightly different ways, but it is a good starting point to start thinking about what might some of those topics be that you as a company are looking at that might be material to your business. Mm-hmm. And under each of these topics, there are often a number of metrics that you could be reporting on, which goes to the core of ESG. It is a tool for corporate reporting that enables you on some of these topics, collect data, get it in a comparable format so that each investor can look at the same type of information across a subset of companies, easily compare that. Now, mm-hmm. if we look at this, is there anything in particular that you would say when you're looking at how a company is performing, looking at their sustainability data, are there particular key areas there? You already flagged that decarbonization of the world, energy transition. Mm-hmm. I think a lot of people at large are focused on that environment side of things. Climate is often the first thing that comes to mind. Climate regulation is the first thing that we see being implemented across the world, across jurisdictions. So there's a strong focus on that. Is that true for you as well at Change Finance? And are there any other particular areas that really matter to you?
Mm-hmm. Well, first I'll just tease you a little bit. You're working with some nerds when they put up a slide with a giant table for everybody to sit and read and try and figure out. So what I'll say is, I was looking a little bit through this list with the idea of spotting something that we don't measure. And I'm not sure I can find one yet. I would say that I think you would be hard pressed to make a really strong argument that I couldn't make the counter argument to, that each and every one of these has some strong material opportunities for us as investors. So we certainly do this at the publicly traded level, and I understand that many of you are in companies that are just beginning to explore this, aren't at the place where you're looking for investment from a firm like ours. And so don't look at this list and say, oh my God, if I'm not doing all of these things, they're not going to care. I might as well not even bother. There's a level to which sitting down as your own organization and saying, all right, which ones are we actually already managing towards? And what steps could we take towards measuring this today? Even if our results aren't great, anything that you measure to on this list and you start to measure internally within your company as a KPI, this is going to lead to your opportunity to actually manage towards that better. And it'll actually set you up to be prepared for the time where you start to get into this larger scale of reporting that would apply to us investors at the public market level. Many small cap and micro cap companies in the United States are really just starting down this direction because they didn't see it coming as they were getting their businesses up to 100 million in market cap, 1 billion in market cap, 10 billion in market cap. And so they're having to go back and do this work at pace because now us types of investors are really where they're going to make sure that their stock sells and that they can have adequate stock price performance so that their boards and their CEOs look good and have jobs in the long term and receive their bonuses related to stock price performance. But I imagine that there's some of these that would probably be a lot easier to measure. And I have a feeling that there's a list here that Socialsuite already works on to make that easy for you to get going. But yeah, without the back and forth Q&A, I don't think there's probably the opportunity, at least at this point, to get into a conversation about any of these. But is there something here that you see, Tim, where you go, are you sure that there's some material impacts and to the bottom line and to the stock price performance? And I'll make you a case.
Yeah. So how we look at it is that when we work with a really small company, I think to your point is don't be overwhelmed here. These are some of the topics that you might come across when you Google ESG. You're running all kind of terminology there, and these are some of the key areas that could be relevant to your industry, to your business. And what we find with companies is find that subset of information that really matters to you. And the key here is that what we see is that the main thing with reporting is don't try to report on things that don't matter. So it's about materiality. What is material to your business? Do a materiality assessment. Look internally, ask your internal stakeholders, all the way from your board, your management and employees, and go external as well. And ask your investors, ask your shareholders, your customers, suppliers, like what are the topics that they believe are material to you? And that the materiality in and of itself is interesting. There's two ways of looking at that, and I think that we saw it in the chat come up as well. Is the traditional way of looking at materiality is how does this topic potentially impact your enterprise value? Mm-hmm. So if there is a potential or actual way it might impact your enterprise value of your business, it is material, and you should be looking at it and reporting on it. But the other question is, can we look at how the impact of companies, of their activities, is actually impacting on society, people, and planet? So that's what I call the other side of materiality, impact materiality. And that is where you're looking at what are those activities that I have that are actually pumping more CO2 in the atmosphere, and can we do something about that? What is the impact of not understanding my diversity and inclusion, and once I actually look at it, I don't have any females on the board there. How is that impacting at large participation of women in business, etc. So all these things it's looking at both sides of that. And once you do that materiality assessment, we find that you come to a subset of material issues that you're reporting on. And to your point, Andrew, once you start reporting, when you start measuring something, you automatically start improving. So it's that start with just measuring and getting that baseline. And it might not be perfect. And it might be that on your 15 material issues that you don't have any information, but at least you know that. Mm-hmm. And at least you've started the journey there. So that's a little bit how we look at that. So I think to your point, don't be overwhelmed. And a slightly easier way of looking at some of these topics is what people might be more kind of familiar with is the Sustainable Development Goals. 17 goals that we globally work towards. They all have a number of targets under there. So it's not per se direct ESG as in a standard or framework that you're reporting on. it's more globally where we want to end up. But you can quite easily, from those topics that we just looked at, look at how does that align with any of these SDGs. And once I understand my material topics, what are the key SDGs that are linked to that and related to that, and where are we having the most impact? And by doing that, we do see some investors that say, well, we really focus on a number of SDGs. That is, our kind of way of looking at things. Is that something that applies to you as well? Is there any particular SDGs that stand out more to you? Or is it the same thing you mentioned? It really depends on where the business, what industry, what type of business they're in, and you kind of work across all those SDGs at large.
Yeah. It's just the SDGs were a key framework that we used in developing our own methodology behind our investing. I think that last I checked, we have metrics that we measure corporations on, or we receive metrics from third-party data providers and ultimately from organizations like you and the reporting you do to those organizations related to 14 out of the 17. And that's just because 17 partnerships for the goals. Maybe we have that, so maybe it's 15. But I would, going back to something we were just talking about starting where you are and taking the opportunity to start measuring what's most material to your organization. There's a really cool example of a company that's publicly traded called Interface. They make carpet squares for probably 8 out of 10 of you's offices, if you still have offices, are using tile carpet squares. And this was an organization that was run just like any other industrial corporation in the United States 20, 30 years ago. And the CEO at the time read a book related to these issues. And for him, it ultimately came down first and foremost to a values-based reason. He was a Christian man, and he had this sense that if he wasn't making sure that the planet was there for tomorrow's child, then he was leaving his work in his religious beliefs behind. So what he did, in fact, is he went first to his frontline employees at the factory, and he said, "What could we do? What do you understand? Running, sitting on the floor of this business. What do you understand about something we could change that might make a difference for something we can do?" And the answers were really fascinating from folks. And there were many different topics that showed up that they started to begin measuring, managing towards, and starting to shift the infrastructure under the organization. So, for example, an idea arose from people on the factory floor that said, "Hey, if we need to move a lot of water to do what we do, and right now we have to put high pressure into these little pipes, right? And it's really energy intensive. But if we were to have really big pipes with really slow moving propellers, we might find that we're able to move all the amount of water we want in a different way." And what they ended up finding was like, oh heck, when we do that, we're actually saving significantly on our energy costs, and that directly affects our expenses. Oh wait, if we just change our lighting to these longer lasting light bulbs that use less energy, all of a sudden, wait a second, we're saving a lot of money on our energy costs and driving down our expenses further, and on down the list. And Interface is a company that I believe has reached carbon neutrality and maintained it, I think, for over a decade. It might be 15 years. And they, and while it began out of this religious sense of a moral sense of his obligation as the CEO of an organization, it came more and more to be driven by the outsized returns they saw from lowering their expenses. And in fact, later on down the road, that came to represent some of how they marketed themselves and sold themselves to customers, which led to outsized revenues and being able to steal business away from other organizations who hadn't considered this a lick. Just thinking on all of this for you all, I have a sense that starting at the bottom and asking these questions directly of your employees would be a great idea. Similarly, there are a number of other stakeholders, right? Us investors, more and more we care. This is another stakeholder. The community will have ideas for you. They're a stakeholder of yours. Your customers are going to have an idea from you. And hell, if you're going to listen to anyone first and foremost, that might be one of the groups to pay a lot of attention to, because what they tell you is what they want to see in order to keep shopping with you. We call that social license risk, right? If you operate your business in a way where the people find to be apprehensible in some regard, eventually they're going to start shopping somewhere else. I mean, Walmart has done some amazing things in relation to driving sustainable change, lowering energy footprints, water footprints, and on down the list, with all of their suppliers and sub-suppliers for what they've asked for. And yet, if you're here shopping in the US, many folks have a sense that Walmart's the last type of store of that kind that they'd want to shop at. They would rather pick Target. And I don't know that Target, at the end of the day, honestly has significantly better performance on how they treat their employees, but they do to a degree. And that leads to Target seeing an increased market share at Walmart's expense. So certainly paying attention to your customers dramatically matters. So you can go at this from any direction. And something Sandeep was discussing with us, so, I'm guessing he's probably not making it at this point, or I'll jump in for the Q&A part. Something he was suggesting as a potential starting place is to go to your CFO and say, what do you have a sense that we could begin managing towards, begin shifting within our businesses that would be material to our bottom line? And so there's a number of different directions you can start at. I'd say start whichever one sounds the most fun, because you saw that really overwhelming list of topic areas that ultimately, by the time you get to me, we're going to ask you to have measurements on all of and do solid reporting on all of. But starting from whichever place actually sounds like the most play, I think might be a really great way to go about this. And I personally loved that story of Interface and how they started with their employees in the factory and found significant improvements, ones that the CEO would never have considered to drive their bottom line.
That is a really good real world example of doing that materiality assessment. It's really looking at what matters to us, what is relevant, what is a risk to our business, and what is an opportunity. And often people frame ESG too quickly as a risk mitigation exercise, but there's a lot of opportunity in there as well, which are not just good for the world, but good for the bottom line as well. So it's finding that shared value there that can really make a difference, and listening to all your stakeholder. The solutions are not just at the board and management level, like just go deep in that and go wide. And that's often what we see as well, and what we do at Socialsuite as well. Start all this work with that materiality assessment, really get an understanding of the lay of the land around sustainability and ESG, and take it from there. So with that, say companies started that journey, done some initial work on that, really keen to demonstrate that they are doing their work. They might not be perfect, still a long way to go, but how do you ensure that a company really can best highlight their ESG work and progress and credentials to investors? What I often see is that companies might produce a once a year ESG or sustainability report, and then that's somewhere hidden in the investor center on their website under the news items, 5, 6, 7 levels deep down there. Without you looking for it and finding or searching the website, it won't come up. So that's really a missed opportunity, if you ask me. So what are some of the logical ways that smaller companies that starting this journey can get that information out there, and investors that are more at that, looking at that kind of small mid-cap level, how can you get them to really find your ESG information easily?
I think especially for many of your organizations, it'd probably be as simple as putting a sustainability page or section directly on your website. So say you were to start today and you want to measure your water footprint, you begin to look into it, you see how it's material for your organization, how it can drive your bottom line at the end of the day. I would put something on your website that says, hey, where you are today, I don't think there's anything wrong with reporting where you are today. Most of us investors are not really going to be surprised by the answer. Oftentimes we can back in and kind of guess where you're going to be. But what often stands out to me is when an organization is willing to say what their targets are going forward, how they plan on changing their business model, their infrastructure to support, say, in this case, a reduction in their water footprint. And so making those sorts of determinations about where you want to start and just listing those on your website for now and setting goals for where you're headed also gives us a chance to see, how your profitability might increase over time. I think it's as simple as that. By the time you're headed in the direction of being publicly traded, you got to get ready, right? I think at that point, your reporting gets more significant, and you probably would want to start reaching out to some of these ESG rating agencies like Sustainalytics, MSCI, ISS ESG, and some of these other major firms to talk with the kind of analysts that are going to be rating your company and saying, what are you going to start asking me to have, right? The framework, the group that we use is called ISS ESG. We tend to appreciate their perspective coming from the same ecological economics world that we come out of. And so in their case, say you're looking at water footprint or you're not looking at water footprint and they ask you for it, right? Say you have an incredible water footprint score. If you had measured it, if you were ready to report on it, your policies, your outcomes to this organization, if you don't have that report, they give you an F. They assume anything you're not reporting on, you must be terrible at, right? And that's really nice for us at this high level of investing to get a sense, right? If you're looking at Tesla and they're not reporting on the substances of concern in their supply chain, that tells me a lot of what I need to know, right? Because at that point, a company like Tesla is going to report anything that looks good, and anything that doesn't look good, they're not going to report. So they probably deserve an F. But likely in your case, that's not true. Likely in your case, it's just a matter of what you have capacity for now. So by the time you're headed in that direction and you see this heading for you, reaching out to these analysts is probably a great way to get some free advice on how to shift your organizations. I know in Singapore, ESG investing grew so rapidly that most CEOs of corporations just went out to buy their own data and see their own score. And they started calling up these analysts by the phone and saying, what does this mean? How do I get this from a 2 to a 4, or whatever measurement structure they work on? I need to get this good of a score to make sure people continue to want to invest in my company, because at the end of the day, if nobody wants to invest in your company, your stock price is going to fall. So certainly I think in the early days, just start with a website. Just start with a top line page, right next to your about section that says sustainability, and tell me where you're headed and what your goals are.
I think that's a really good point. And with that, looking at the main steps that companies can take there, I think that, just get your information out there. And what we see as well is, to that point, is that once you get into that landscape of rating and scoring by ESG rating and scoring agencies, is that it is often the case that it's not about how well you do ESG, it's about reporting on what you're doing. And I think that's a key takeaway as well, that just get started. It's not about being perfect, but it's about having something in place, having thought about it, demonstrating that you're measuring something. You'll get some points there. If you don't talk about it, you get the worst score, basically. So I think, again, measure, and that leads to improvement. And just the fact that you're measuring something often leads to a better score than just not doing anything at all. So there are really small things you can do, and just keep in the back of your mind that, yes, that first ESG, that baseline, that line in the sand, like we're here today, there might be a lot of, we don't have the data, we don't know yet, we do have a commitment or a goal in mind. And that is often enough to get you at least somewhat decent ESG score from a rating agency. And from there, you just keep improving. So the 5 things that for small companies are generally quite important to look at is first and foremost, a lot of ESG reporting is still voluntary reporting. You do it because it's important to your business, to your stakeholders, to investors. But from a regulatory point of view, there's not a lot happening right now, as in that you have to do, but there's a lot of regulation and compliance on the horizon. So that's always something to really keep a close eye on what is happening there. What we've been talking about today is really about understanding what your investors actually want to see. What do they care about? And I think there's been some really good nuggets shared today by Andrew about how to think about these things, what to do first. So that's really useful. Consider that return on investment as in, where do you start with this today? You don't have to go out and straight away spend an extreme amount of money on starting ESG reporting. It's about finding the right size solution, starting point. Go to your CFO. This is also what Sandeep mentioned, where we had a bit of an initial chat, and it's unfortunate that he couldn't make it today due to technical issues. But he said, just get a small budget from your CFO, just a little bit, to at least have it on the books that you're going to do this, and start from there. And once you see that it's not that hard, and once you see that there actually is value in there, then keep doing the work there and look at that return on investment ultimately, like how well is that going?
Mm-hmm.
And related to that, don't make it too hard on yourself. So find something that is actually doable in terms of reporting. Find a few things that you can do well. Look at how you can build capacity within your business, and just move on from there. So ultimately, it comes down to that. Just take a position. It's not a fad. It's not a thematic thing that will go away. It's just another way of looking at how the performance of your business is doing in the short, medium, and long term. So for most companies, it's a matter of don't delaying it. Don't wait till that ultimate point where you feel more comfortable because you believe there's a sense of perfection. You'll never get there that way. It's about starting today and moving gradually towards understanding what you're doing around ESG reporting. Is there anything around this, Andrew, or any final thoughts that you can share with us that you believe for company that is exploring how to do ESG or get started with that journey that really comes to mind? And while you think of that, I would invite everyone to just, if you have any final questions for Andrew, put them in the chat so we can look at that and go over that. So put them in there. But first off, like on those matters there, what is your tips to companies that are listening maybe and think, oh, it is time to get started?
Mm-hmm. Oh my God, I think I gave all the tips. I think it'd probably be enjoyable to take some questions from folks. I see one in the chat. Does ESG fit for investors and companies looking into nonprofit investing, philanthropy without a financial return? So if I'm understanding your question correctly, as an organization that's putting their dollars, their philanthropic dollars to work, yeah, I think that this would still matter. It probably would matter for potentially different reasons, right? It certainly could make a material difference on the nonprofit. If they have, if it reduces their budget costs, increases their opportunity for revenues within. I mean, it's certainly a direction a lot of philanthropic organizations have chosen to head, is to figure out a way to monetize some of the work they're doing in a way to make their organizations more sustainable. So in that case, many of these same issues could matter. I think, it would be up to some good thinking with you and potentially with the executive director of the organization to say, what are some adjustments that relate to some of the things we talked about that could, affect the budget annually for your organization, make you more sustainable and long-term and need less and less of our money, or use the same amount of money we give you to drive more impact. And alternatively, I think you could look at this, giant list you saw, or do some digging on Google for lists of the type of impacts that these organizations have. Certainly, we tie them all back materially as investors, but I think at the end of the day, you could look at them and say, we do believe these are good for the world. We do believe these are good mission-aligned impacts that this nonprofit could have. So we'd like to see you head in that direction. And then I guess my last point while I'm on the subject is that many nonprofits, philanthropic organizations will have an endowment. And then where that endowment is invested and how that is invested is an opportunity to do the same. So to call out somebody quite big, the Bill and Melinda Gates Foundation has for a number of years, I don't know that they still are, for a number of years was one of the largest investors in private prisons in the United States. And so there was a big conversation to be had that, you know, Bill certainly didn't want to have, that said, hey, this directly goes against the impacts you're trying to have as a nonprofit. And so he wanted to say, and wanted many to buy into the idea, well, I'm getting sizable enough returns that I'm going to reduce that impact. And for those in the United States who understand the impacts societally of what's known as the prison industrial complex, can see is that it's actually led to dramatically worse outcomes, especially for communities of color in the United States. And so I don't believe he was right at all. And then simultaneously, those have become to be quite terrible investments. I don't know that his outsized returns that he hoped for from investing in prisons actually led to increased capital within his endowment to make the kind of meaningful change he wanted to make around the planet. So I think endowments could look really carefully, not just at their foundations, not at the 5% that they plan on giving away annually, but the 95%, and see, are those in alignment to create the same outcomes we want to see? And also, are we actually looking at this in a way that our endowment is going to have sustainable returns in the long run? Because there's while we care about all these subjects deeply, we also just think that this is the way to the largest returns in the medium and long term. And that's how every endowment should be thinking, just for their 95%.
Thanks. That's a really good insight there. And what I would add to it is what we see happening is that not-for-profits, especially on the smaller end of town, a lot of them are you're quite dependent on government grants. We often see. And there's a real kind of drive within that tendering and procurement from government that are asking the same questions. What are you doing around decarbonization? What is your energy management? How are you dealing with diversity and opportunity? So ESG or sustainability reporting, from that matter, is equally within that kind of sphere there. So if you're a not-for-profit and you want to really kind of position yourself well for that government procurement and tendering, ESG equally matters. So across the board, it really goes into the overall performance of your business and demonstrating you understand what you're doing and doing better on that. So with that, I think that I don't see any additional questions there. So I really want to thank you for all your insights shared with us today, Andrew. It was really useful to get a view from an actual investor, what I look for, how that works, and for companies that are sitting there thinking, oh, we should be doing something here, to see that there's some really good examples of companies doing this and how they go about it. So I want to thank all our attendees today as well. And if there's any further questions for anyone, feel free to reach out to me. I will talk a bit more about how you can start your ESG journey. Thanks, Andrew.
Thank you all. Nice chatting with you.